I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game, because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. It just, nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to, whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and the defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged, because we're still in a dollar short squeeze where there's more debt than dollars that exists, and that's what's going to happen.
We saw a little bit about performance on that last leg by silver, but really gold and silver moved together for the most part. So that signals that we aren't at a blow-off top stage. Can you share a little bit about the gold-silver ratio, and what that signals to where we are in the bull market?
Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918. Since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. So it was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like, obviously, like, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like, we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best. And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down. And either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine. So I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up. Limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.
I think the most important point to understand right now, before we get lost in the day-to-day noise of price charts, headlines, and Fed speak, is that we are not yet in the final sprint to the endgame. And by endgame, I mean the terminal phase of this debt supercycle, when fiat credibility finally collapses and sound money, gold and silver, reasserts itself. We're still waiting for the next round of money printing to begin. The reverse repo facility, that magical piggy bank of excess liquidity, has been drained. The cash that banks and money market funds had parked there has been steadily used up. And yet the Federal Reserve hasn't pivoted. Quantitative tightening hasn't stopped. It's slowed down, sure, but it hasn't been reversed. Rates haven't been cut to zero. The Fed isn't yet buying bonds on net. We're still in the prelude. That's what makes this gold rally so extraordinary. Gold has already run higher and faster than most people expected before the next flood of liquidity. Usually, gold doesn't make its parabolic moves until the printers go brrr. So it's worth pausing and realizing how remarkable that is. But it also means that gold won't simply go up and up every single day from here. It's not a straight line. Until the Fed actually starts easing again, until the next crisis hits and they're forced to reflate, we're still playing musical chairs in a global dollar short squeeze. What does that mean? It means there's still more debt than there are dollars in existence to pay it. That's how the system works. Every dollar is created as debt, and interest makes the debt grow faster than the supply of dollars can keep up. So the moment defaults begin, the game stops, the music stops, and everyone scrambles for chairs, or in this case, dollars. That scramble for liquidity temporarily pushes the dollar higher, and everything else, stocks, commodities, gold, silver, sells off. It's mechanical, not emotional. Remember what happened in March 2020 during the lockdowns. Gold sold off. It dropped to around $1,450, and miners were annihilated. Down 20%, 30%, even 40% in a few days. Everyone panicked. But then, the Fed unleashed the most aggressive money printing episode in history. They didn't just cut rates to zero, they printed twice, 3 times, 4 times as much money as during the Great Financial Crisis. That's when gold and silver went into orbit, climbing day after day with no meaningful pullback until they reached record highs. The same pattern will happen again, only this time it'll be on steroids. But we're not there yet. We're still waiting for that oh no moment, the event that forces the Fed's hand. It could be a bank crisis, a derivatives implosion, or a sovereign debt accident. Maybe it'll be triggered by a major treasury auction failing, or a large European bank suddenly collapsing under the weight of bad bonds. Whatever the trigger, the result will be the same. Panic, liquidity freeze, and then the mother of all bailouts. Until that point, the dollar will remain in a perpetual short squeeze. There will always be more dollar-denominated debt than dollars themselves. And that structural imbalance creates periodic surges in the dollar index and sell-offs across risk assets, including precious metals. It's not a failure of gold, it's the system gasping for air. So when we get one of those sharp sell-offs, like the one we saw in late October, it's not the end of the bull market, it's just turbulence before the next ascent. These corrections are inevitable, mechanical, and If you have the right perspective, healthy, they shake out the weak hands and reset sentiment before the next leg higher.
So the reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started at the peak of the balance sheet was sometime in 2021 for the last 4 years, maybe 2022. I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them, the bank reserves. Now, I had a theory which ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night because they're trading the reserves. So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio the bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion. And this week's number, which should be out in a few hours, and in 2.5 hours it'll be out, and I'll check it. It should be like something like $80 billion less, because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like $930 something billion. It was whatever it was like $60 or $70 billion more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion, so it's like 2.91 trillion or something, and the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves run out. It's being used. And sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding, as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just you're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. And it's going to end soon because the repo rate is already moving several basis points a night. It's already tight.
Let's talk about what that final sprint might look like. Because it's not just about metals. It's about the entire monetary ecosystem imploding under its own weight. The dollar short squeeze is like a slow-motion implosion. There are more debts denominated in dollars than there are dollars to settle them. Globally, it's something like $350 trillion in debt versus a money supply that's barely a fraction of that. It's an inherently unstable structure. So when the music stops, defaults start. Companies, nations, even banks scramble for dollars to pay off obligations, and liquidity disappears overnight. That's the moment of panic. Everything sells off. Stocks, bonds, real estate, crypto, all of it. Even gold and silver dip, because people sell what they can, not what they want to. But then, as always, the Fed steps in. And this time, when it prints, it won't be a gentle easing. It'll be a deluge. That's when we enter the final sprint. The Fed will cut rates to zero, restart quantitative easing, and this time it won't just be a few trillion. It'll be several times what we saw in 2020. Central banks globally will follow suit because the entire system is interlinked. They'll flood the world with liquidity to stop the defaults. And that's when the dollar dies. In that environment, gold and silver won't just rise, they'll melt the charts. Silver will decouple from gold entirely, because it always does when credit disintegrates. In every previous inflationary reset, 1918, 1968, 1980, 2011, silver has gone ballistic in the final phase. It's like a monetary siren, and it's not just monetary speculation, it's psychological. Silver is the people's money. It's cheaper, more accessible, and more emotionally satisfying. When the masses finally wake up and rush to protect themselves, they won't be buying kilo bars of gold. They'll be buying silver coins, silver rounds, silver anything. That retail wave will collide with institutional demand and industrial shortages, creating an upward panic. We saw a glimpse of that in 2021 with the silver squeeze movement. That was just a spark, a social media curiosity. Imagine what happens when it's driven not by Reddit hype, but by fear. In 1980, silver hit $50 an ounce, equivalent to about $200 in today's dollars. And that was with 1980's money supply, which was tiny compared to today. In a world awash in $300 trillion of global debt, a silver price of $200 is not fantasy, it's arithmetic. Now let's bring back the gold-silver ratio. Historically, at the peak of each major metals bull, the ratio compresses to between 15 and 20 to 1. Today we're around 80 to 1. So if gold reaches, say, $6,000 in the next inflationary blowout, a perfectly plausible number based on previous cycles, then silver at a 20 to 1 ratio would be $300 an ounce. That's not a meme. That's what math looks like when the monetary system resets. Now, some people ask, Rafi, are you saying the system collapses completely? No, not necessarily overnight. But there will be a reset, a repricing of assets relative to real money. Every fiat regime eventually meets this fate. It's just that ours is bigger, more global, and more digital. The interesting part is what comes after, because every reset is also a rebirth. Out of the ashes of fiat will come a new system, perhaps anchored to gold again, perhaps partially digital, perhaps regionalized. But whatever it looks like, silver will play a role, both industrially and monetarily. And remember, we've been here before. 1979 felt chaotic, but it was just the natural consequence of decades of debt and inflation. The same story is playing out again, only this time it's global and instantaneous. So what do we do in the meantime? Stay rational, keep perspective. The volatility we're seeing in metals isn't a bug, it's the signal of transition. Each correction shakes loose the complacent, each rally draws in the believers. The real wealth transfer happens quietly during the consolidation phases when everyone's distracted by the next AI bubble or crypto fad. When the dust settles, the people who held their ground, who owned real money, will find themselves standing on the other side of history with something tangible, something enduring. And yes, silver is volatile. It's wild, it's emotional, but it's also real. You can hold it, weigh it, store it. You don't need a counterparty's permission to own it. And when the system wobbles, as it will, that physical reality will matter more than any digital illusion. So we wait. We stay patient. We don't get euphoric when the price spikes or despondent when it drops. We understand the rhythm of the game. Tightening, panic, printing, collapse, reset. It's a loop as old as central banking itself. Right now, we're in the tightening phase, the prelude. The next phase is coming, and when it arrives, it'll happen fast. The moment the Fed pivots, there'll be no going back. That's when the final sprint begins. And when it does, silver will do what it always does at the end of every monetary era: explode higher, outperform gold, and announce to the world that the game has changed.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.